Hi Rajesh ji, how are you?
Hi
Hi,
गौरव जी,
hi Karthik, how are you?
आई एम गुड। आप कैसे हैं गौरव सर?
एकदम बढ़िया, एकदम बढ़िया.
ग्रेट, गुड टू सी यू।
Yeah, same here.
Yeah.
So where all do we get live?
Welcome, Gaurav
We go
ji.
live on YouTube also, or how do we do it?
Yeah, we will live in YouTube shortly.
शिवम, तुम्हारे पास माउस है ना?
So let's wait for another 5 minutes. We'll start.
Opening remarks are supposed to be by Girish sir, na? Is he?
Yeah.
Okay.
Girish
Hi
sir is there.
Girish sir, how are you?
Hi Girish sir. Hello Girish sir.
Hi, good evening all.
Hi,
Hi,
good evening.
Girish sir,
Not
how are you? Nice to see you.
at all. Good to see you all too.
Girish, I'm coming to Pune ideally on 15 to 18 February. Are you there?
See, I don't live in Pune. I'm based in Bombay.
Okay.
I
I've seen a lot
Pune
of
very rarely, not every
things.
once in 15 days or so. So
Oh,
when you come to Bombay, just text. We'll see how to go.
okay.
Yeah, hi both. Neha
Hi
this
Neha,
side.
how are you?
Hi Neha.
I'm I'm good. Hi Giri sir. Hi Gaurav sir. Hi Karthik.
Hi Neha.
I
Hi.
hope admin please make sure everything is in place. They are able to share their screen if they want to.
Hmm. I am able to, I think so.
Please check.
Yes, they can.
Hmm. Yeah.
So Karthik would be hosting for you guys today.
Yeah.
Uh,
Thank you,
I
Karthik.
am actually traveling with family. I'm in Gulmarg right now.
Oh, wow. Okay.
She's enjoying Kashmir.
No, with the beautiful background at your back,
Yes.
it would have been great to see you hosting as well. Is my voice
Shall we
audible,
start?
Karthik?
Huh?
Is my
Shall we?
voice audible clearly?
Yeah. Shall we start, Neha?
So for me, Gaurav, there is some lag. There is some lag in your voice. For Karthik was Gaurav's
Yeah.
voice all right?
It's perfectly fine.
Okay, there was no breaking, na?
No breaking. Shall we
Perfect.
start?
Giri sir, how are you?
Very well, thank you. How are you?
I'm good. So Karthik, Giri sir would be taking up the first session as I informed you, and giving the practical tips to
Yeah.
our members. And we'll go online first on YouTube and then start it.
Yeah.
And फिर उसके बाद ऑफ कोर्स कोई क्वेश्चंस इफ यू वांट्स टू टेक अप तो वो ले सकते हैं, और पार्टिसिपेंट्स के कुछ हैं ऐसे रेलेवेंट क्वेश्चंस, एंड देन कैन गौरव कैन टेक अप द स्टेज। वो फिर टेक्निकल सेशन अपना कंटिन्यू कर सकते हैं आराम से,
Yeah.
1 hour, 1.5 hour, whatever you want to do, Gaurav.
Yeah.
Take whatever questions you want in your own way.
Yeah, whatever Girish sir leaves for me, I'll pick up from there.
No, actually, it is your session, Gaurav. I'm there for 10, 15 minutes,
Okay,
whatever
okay,
they.
sure.
Essentially, what you can do is, Karthik, you can stimulate the questions because uh, mine is a generic session. What are
Yeah,
value opportunities? So you can just stimulate the questions and let anybody ask whatever questions they
yeah,
want.
sure, sir, sure.
Gaurav, between 20 minutes, I should finish and then you should take it over. It's your
Sure.
session. All the
Sure.
best.
Thank
Yeah,
you. Thank you.
thank you.
Thank
So admin
Perfect.
team,
Thank you so much for your humble presence, sir. Karthik, we can go online on
Yeah.
YouTube and we can start the session.
yeah. So admin team, kindly go online. Rajesh sir, are we online?
Yes, Karthik, yes, you
Yeah,
can
yeah.
start.
Okay, sure. Thank you. So first of all, I would like to welcome you all in the session webinar organized by the Voice of CA in the scope of valuation for chartered accountants and practical aspect of discounted cash flow. So I welcome our guest of honor. हमारे सामने बैठे गिरीश सर, our session speaker Gaurav Sukhija sir, Neha Agarwal, Gautam sir, Rajesh sir, and all the esteemed members there. So, Voice of CA is a chartered accountant association which serves the chartered accountants for any job opportunities. And we are a founder, and CA Sanjay Kumar Agarwal sir, Honorable Central Council member ICI, is a founder of Voice of CA NGO. And since last 17 years, Voice of CA is serving to the members and the students. We are giving opportunity for the members as a state speakers and mass mails systems. So I again welcome to all this. So let's introduce our first speaker, first guest of honor, our honorable guest of honor, Girish sir. So sir is a chartered accountant and founder Transaction Square and former tax leader at KPMG. Sir needs no not at all introduction. Sir is having 27 years of professional experience across multiple leading firms, 13 years of experience in KPMG. Sir handles India's top clients and all the, and he is a national tax leader in M&A also. Prior to the KPMG, sir was a partner at Arthur Anderson over a decade. He has worked with many large multinational firms in companies in advising them of various business, tax, and regulatory issues. And sir is also a vocarious leaders. And sir, we are very honored that you have accepted our invitation to be here, and as a part of guest of honor, we all are very humbled and feeling very proud. So please, sir, kindly guide us. Thank you so much, sir.
No, absolutely. Yeah. I think should we do this session in a Q&A form because that'll be easy. Because let me put it this way:
Sure, sir.
the CA course teaches us many things, and valuation is one of the more important element of a professional journey. So if you look at the various regulations, if you look at the Companies Act, to issue shares, you need valuations. For doing ESOPs, you need valuations. If you look at RBI, to take money out of the country, you need valuations. To get money in the country, you need valuations. Look at income tax, transfer of shares, there's 11 UA valuation. For issue of shares, there's 5627B valuations. So valuation are getting embedded in more and more regulations. If you are doing accounts, finalizing the accounts, you need impairment valuations. If you purchase the business, you need a valuation of purchase price allocation. So I think personally, valuation is something which is here to stay and here to grow big time. So getting into the valuation as a profession is something which is going to be a perpetual career. So there will be opportunities because India will be flushed with funds and there will be a lot of M&A restructuring. There will be a lot of issue of shares, transfer of shares, which will require valuations in this different kind of regulations. Second opportunity I see for all of us is, which is a bigger opportunity than this, is India being a global hub for valuations. So the Indian cost arbitrage, which is there in IT sector, which is there in, outsourcing sector, will be there for valuations too. It's already there and it will get bigger and bigger. Our talent pool, which is very, very educated and really very, very capable. Say, if you look at GIFT City, Gujarat has the maximum commerce graduates. So if you add all the commerce graduates, then you can set up the best valuation outsourcing center in Gujarat, GIFT City. And this could be valuation, this could be accounting outsourcing. It could be anything which is financial, not necessarily only valuation, because valuation takes you to financial efficiency, management, so on and so forth. So I think the opportunity is huge. There are two things which one need to also bear in mind. The risk is also huge. So when Karthik, you said DCF worries me.
Okay.
So projections in DCF, relying on projections without questioning the projections, randomly signing off on anything which comes your way, or signing in a contradictory manner. So look at unicorns. 2 quarters the value goes up, 2 quarters the value goes down. Signing reports 4 times a year for ESOPs in a company which value fluctuates. That is something which is going to be a problem. So doing things to please the client, doing things to do things without backups, the investigators will call you. So I know a lot of investigations where the GST authorities have called you for valuations, or even the DDIT in income tax calls you for purchase price allocations. So there's an opportunity, there is a risk. And to manage the risk is going to be the key important success parameters for people who want to build perpetual valuation businesses. And the second important thing which will be important is, how do you build a valuation team? So Karthik, how do you build a valuation team? Should you hire only CS or what should you do?
I will hire CA, CMAs also, CS also.
So actually to build a valuation team, you will not need more than 5 or 7% CA or CMA. The
Absolutely correct.
remaining 95 have to be graduates
Graduates. Okay.
who will work on a process. Otherwise, you'll never be cost competitive in the market. So you need 5 or 7% people who need the subject, to understand the subject, and the remaining 95% who work on a process. Because it's got to be so competitive, you will never be able to manage a cost structure if you hired a top-heavy team. So it's a very huge opportunity for CAs to be an entrepreneur, to be in that 5-7% bracket, to create jobs for the graduates and create the best valuation practice built on ethics, models, questioning, build on the right parameters. I think it's a very, very big opportunity. With this, I will pause for any questions you all have, because I have committed myself to 30 minutes slot. But Gaurav, Karthik, anyone else, any questions you all have in your mind which you want to learn from my experience?
I have one question, Giri sir. You come with a vast experience of, time. I wouldn't say just you were in KPMG or you did Transaction Square, whatever you've done, but you've walked through the time altogether. I would want to understand how the landscape of valuation has changed in your eye, and what is your thinking upon different regulation and regulatory requirements under valuation? Like in FEMA, you need valuation by a chartered accountant or a merchant banker. In income tax, it's separate. In Companies Act, it is registered valuer. How do you see all of this becoming uniform over a period of time? And even methods, they are differently described at the various places. Why all this happened? Are regulators working in silos? And how this landscape has changed over a period of time?
I would think that convergence will not happen. It will be only more divergence. And all will coexist. Registered valuer will exist, CA will exist, investment bankers will exist, Indian, international, all will coexist. Because the laws are getting so complicated, all will coexist with conflicts in a divergent way. Is that an opportunity? Answer is yes. But is it a threat if you don't manage the conflict? Answer is it's a big problem. So you have to decide how will you manage conflicts. I'll give an example. Take an example of court mergers. You have to give a valuation report under the company court rules for a merger or a demerger. Previously, the concept was that if the shareholders approve a merger or a demerger, it is approved for all purposes. Nobody can block it. However, now, if you're a listed company, SEBI is rejecting valuations. SEBI is calling the value for a discussion to understand the projections. And if not convinced, they are rejecting it. So the landscape will change from your judgment to convincing the authority, which is changing already. And soon it will be the discretion of the regulators. So if SEBI doesn't approve something, it will be out. If RBI doesn't get convinced with somebody, your valuation report will be a piece of paper not worth anything. So being empowered to put your signature into something, to going ahead and standing up and defending it and convincing somebody is got to be equally important. And to not land yourself into trouble, because assuming you were doing valuations for banks and the company goes bankrupt, then NFRA also will run behind you. So I would think management of risk is going to become more and more important as we look at a valuation career. There's an opportunity, there's a risk to be managed for perpetual existence.
Thank you so much, sir. I just have one question, sir. Sir, hello, I'm audible, Gaurav?
Yes, you're audible.
Yeah, sir, I just have one question. How NDS and IFRS plays an important role in the valuation?
NDS and IFRS is a big opportunity for valuation. In both the regulations, when you acquire a business, you have to do a purchase price allocation. So that's a very big opportunity for professionals. Then when you do consolidation, you'll have goodwill in the consolidation. The goodwill has to be tested for impairment. That's a annuity work for valuations. So NDS and IFRS creates huge opportunities for valuations. But suppose you do a reckless job wherein you don't impair something which is really not right. Then if the company goes bust, you'll be held responsible. So the valuer will be as accountable as an auditor is likely to be, because it's a professional judgment on which some decisions are based. And that professional judgment has to be sound and has to be backed up by appropriate judgment calls. So I would say the enthusiasm has to be matched with the maturity of doing the right things.
Thank you so much, sir. I just have one question by the participant. Is it okay to call it valuation certificate or a valuation report, sir?
Depends upon the law. In some case, you need to give a certificate. In some case, you need to give a report. Of course, certificate is far narrower than a report, because certificate is more making you more responsible. So depends under what regulations it comes to. Like 11 UA is a certification, whereas a lot of places under the Companies Act, it's a report. So depends. I would say either cases, you assume both is a certificate, and your homework should be such that you are pristine and clear, that you're not signing on something which you can't defend.
So, participant, so any further queries, if you have, kindly ask in the chat box or in the question and answer session. So hopefully your all queries is solved. And so as a voice of CSR, we are really thankful, Girish sir, for your time, valuable time and contribution, and giving your insight as values as experience. So really thanks to you again, sir, from our team, voice of CSR. Thank you so much, Girish sir.
All the best to all of you. God bless
Thank
you.
you so much, sir. Thank you so much, sir.
Thank you.
So moving away from the next part, main technical session by CA Gaurav Sukhija sir. Sir needs no introduction at all. And to be very honest, as far as I know, Gaurav sir is a really gentleman and really highly knowledgeable person, is a suitable one which will guide you on this technical topic valuation related to discounted cash flow. Sir is a partner and national leader at Kirtane and Pandit LLP and ex Big Four, ex Deloitte. And sir is a Gaurav has work experience spread on various valuation, advisory, due diligence, merger acquisition. As a valuation professional, Gaurav sir has undertaken valuation of many business, tangible asset, intangible asset like brands, patent, customer acquisition, relationship, financial instrument. In India, the valuation of financial instrument has a lot of complexity. All the member, you need to understand fact in India is the valuation related to the financial instrument and ESOP also plays a very vital role for the professional who are going to trying to explore the valuation opportunity in the India. And so Gaurav sir has worked with the Big Four in the financial fast team with the SS Patari Mehta, and Gaurav sir has done valuation for many industry, IT industry. Sir ने बहुत कुछ किया है, जितनी तारीफ करे उतनी कम है. So please welcome Gaurav sir with a big round of applause. Gaurav sir, please welcome sir. Thank you, sir.
Thank you. Thank you. Thank you. Thank you. So I'll just share my screen and then I'll start with all the formal thanks. Ideally, just give me a second. Yeah. So a very, very good evening, good afternoon to all of you. And if anyone is watching me from maybe US or UK, which I see a lot of people doing for valuation, a very good morning to you as well. First, I would like to say thanks to Voice of CA. I generally, whenever I do any session, wherever I go with a tie. Voice of CA is like a family. So I went without a tie today. It's just because I felt more like a family. I'm talking to the people of my family members, Sanjay ji, Neha, Karthik. They have been a kind of a support system altogether. Not directly, not indirectly. You'll find them being there around you with a lot of great sessions. Karthik is a wonderful speaker on India's. I am privileged that Karthik is taking the session, is actually hosting the session today. We were privileged to have Mr. Girish Manwari who used to be India tax head for KPMG for a lot of period of time. And then he started to own his Transaction Square, which is one of the leading in the line of transaction advisory again. We're thankful to him for actually saying yes, for giving the opening remarks. My second thanks would ideally be to Mr. Sanjay, sir, who is also a Central Council member, and who has actually created this wonderful platform wherein I see today hundreds of people watching me live on various platforms via Zoom, YouTube, LinkedIn, Instagram, Twitter, wherever we are live at this moment of time. So it's wonderful to see all of you. The last and not the least, I would like to thank the participants who are here. I see a lot of questions already coming, so I'm very happy that I'll have a very live audience today who will keep asking questions, who will keep interacting with me. And I understand we'll have few students, we'll have a lot of members, we'll have a lot of esteemed partners who are part of this. I've got a lot of confirmations from my ex-bosses saying that Gaurav will be joining it today. So I'm thankful that this session is happening, and I keep taking sessions. As Karthik has already given my background, I am partner national leader at Keerthan and Pandit LLP Chartered Accountants. It's a 30 partner, 800 employee CA firm. I take care of M&A tax, valuation, and due diligence. So I keep speaking on valuation and M&A tax specifically. I've not started speaking on due diligence already. I've recently given two seminars, one at Taxman and another as Tax Guru, which is already available on their websites for the M&A tax. And for valuation, it's been a year that I've been speaking, and I've been invited by many esteemed platforms until now. As a valuation professional, I would have not done less than 500 valuations. So, I do not less than 100 valuations per year. So that calls for why valuation as a practice area. Yeah. So Girish sir was actually taking up the topic of whether valuation should be the area where you should be working upon. Before starting with any of this, I would like to know my audience. Can I know that do we have practicing chartered accountants or do we have salaried chartered accountants? Can I have something on the chat, please? That are you practicing right now or you are currently doing as a job? Practicing, great. Salaried, practicing, great, great, great. So I can see, salaried person, but currently working in valuations. Wow. Okay. Practicing CA. So that's wonderful. See, I see that there are people who are currently salaried, who are doing jobs, as well as there are people, who are doing, who are practicing as well. So first of all, I want to talk about valuation as a topic. What is valuation as a topic? Why valuation is needed? Which all, areas do you see valuation being happening, as of now? So now the first and foremost is there is n number of regulations. You see there is a whole list, Section 56 of Income Tax Act, Companies Act, RBI, ODI, Companies Act, SEBI, Sweat Equity, Insolvency and Bankruptcy Board. Under Ind AS, we have a lot of Ind AS which talks about Ind AS 113, impairment assessment under Ind AS 36, financial instrument under Ind AS 109, Ind AS 32, Ind AS 107. All of those requires actually valuation. But first of all, why another line of business is actually needed when we are already comfortably doing valuations, we are already comfortably doing audits, we are comfortably doing tax, we are comfortably doing, few people are doing things which are unconventional. That's wonderful. If you're doing things like forensics, you're doing things like Ind AS, you're doing things like ESG. These are the callings for today. Yeah. Alongside the callings for today, which we generally talk about, there is valuation, transaction advisory, M&A tax, which is actually the call of the today's generation. Now I'll tell you, can anyone tell me what is the code says that is a chartered accountant a bloodhound or a watchdog? Can anyone tell me on the chat, please? Is chartered accountant a watchdog or a bloodhound? Just write watchdog or bloodhound, whatever you think. Bloodhound. That's the beauty. He's a watchdog, but treated like a bloodhound. Yes. So now we were doing audits for a lot of years. We've done statutory audits, we've done bank audits, and all of those. We were called bloodhounds there. That was still acceptable as of now. But now what is happening is if you have filed an income tax return, yeah, even in the income tax return, the income tax department has started asking who has filed your return. A person who has filed the return saying that he filed the return self. Yeah. And still the government is asking that who has filed the return for you. Now, that is that they are coming back to a chartered accountant as such. I say teachers as a watchdog, court considers us as bloodhound. Yeah. So that's been happening over a period of time with a lot of practices we have been doing. Even in the GST, when the people are filing returns, people are asking who filed the return. Now you're filing a return yourself. A chartered accountant is only advising you how to file the return. He is not filing your return. He does not have the responsibility of filing your income tax return or a GST return. He is there to guide you, to tell you how to file the GST return, to tell you how to file the income tax return. That's where it is required. But, there comes the need of new areas to be worked upon. There comes an area wherein the risk is huge, but still manageable. Yeah. Every audit report, whenever you give, there are three options to give. One is a true and fair view. Can anyone tell me what are other two? Whether it is qualified opinion, what do we call it? Can someone please tell me in the chat box? When you give an audit report, you give a true and fair view. What are other two options? Qualified report and adverse disclaimer. Yes, adverse disclaimer. Every valuation report goes with a disclaimer. Yeah. The valuation report starts with a thought process wherein we say that the valuation is done as per the projections given by the company, by the management of the company. And I have not done any audit or due diligence of the projection. It is the responsibility of the management to give me the projections at a very higher end. But projection is also very, very important area to work upon. We'll be talking about various pillars of discounted cash flow. Why are we talking about it? Why am I taking this session is, in the first part, we'll ideally be talking about how do you go and get a business of valuation. Valuation is a very, very ongoing, is a practice right now, which will grow over a period of time. And if you are not doing it, you're ideally losing upon a big chunk of business altogether. Now, I go to a lot of CFOs and CEOs, I meet them, and a lot of CFOs and CEOs ask me, got a valuation to tum karte ho, but does your company also do IFC? So one day I was sitting with CFO and I said, yeah, we do that. He said, how do you do it? So I told them there are some RCMs which are there, which are, which we test actually. And once we test them, we check whether the RCMs are right or not, and we make changes to your RCM if needed. And then we test them under the IFC and we give you the IFC report. Now, I didn't know what RCM is. I didn't know what the IFC is. I don't know how do we create it. But when I know about these terms, the CFO is confident that his organization can ideally do. If someone calls you and asks you, hey, Karthik or Rajesh or whosoever, they ask you that, hi, can you do valuation for me? And you just tell them, sir, I will connect you with my partner who does it. And I wouldn't know anything about it. The work is gone at the same moment of time. Yeah. You need to have basic information of all the areas. So after this session, I'm not saying that you'll learn how to do valuation. You will at least know how to talk about valuation. You will at least know how to do an audit review of valuation. Then an auditor, if there is a statutory auditor in a company, and you are ideally doing the audit, but you're not done the valuation, and your company went into few transactions where you're doing the audit, where the valuations were taken. If there is any problem with the valuation, who will be first called upon? Will it be an auditor or the valuer? Who will be called upon first? I'm asking you a question. If anything goes wrong with the valuation or the regulator has any issues relating to the valuation, who will he call first, the auditor or the valuer? Tell me. Auditor or valuer? Some are saying valuer, some are saying auditor. Yeah, it will be auditor. any regulator, because I'll tell you the valuation under the valuation report, the valuer says that my valuation report is restricted to be used by two people. One is the management and the second is the regulator, but I am answerable only to the client. That is what is written in the valuation report. Now, the point is the auditor will be called upon first and he'll be asked about the question, did you review the valuation report which was submitted while doing this transaction advisory or not? Now, if you don't know how to review it, how will you do it? Do you know in Big Four, approximately 40% business is only of audit review of the valuation? Because I come from Deloitte, from the valuation team and the M&A team. You know, I see that not only in Deloitte, I have friends in EY, KPMG, PwC, all of those places, wherein 40% of the business is ideally coming from audit review. And then comes 40% business, which is for internal management analysis. That is, it is not for regulatory purpose. Just 20% of the total valuation is done for the purpose of the regulatory requirements in Big Four. Which means that there is huge opportunity available in the market for any valuation which is done other than the one which are written here. These are all regulatory valuations which we talk about. It's not just about regulatory valuations. You know, there are various purposes for doing valuation. There is merger, there is IPO, there is acquisition, there is internal management analysis, there is intangible asset valuation, there is income tax, there is SEBI, RBI, FEMA, Companies Act, IBBI, ESOP, purchase price. Can anyone tell me one simple question? Let's say a company's net worth is 20 crore. That company is acquired for 100 crore. What should be 80 crore called? Waiting for people on the chat. I purchased the company for 100 crore. The net worth of the company was 20 crore. What is the 80 crore called? Shreya says goodwill. Rest, please. Goodwill. Premium or goodwill? No. So there is a specific thing which is known as purchase price allocation. I'm sorry, the S is missing. It's purchase price allocation, which is that if a company is acquired, it's not just the goodwill which is acquired for 80 crores. There are a lot of other intangible assets which are acquired alongside. Identified intangible assets which are acquired under the purchase price allocation. For example, if a CA firm has few chartered accountants and you train those chartered accountants in, let's say, 3 months, the chartered accountant's salary is 1 lakh rupees per month. You're actually spending 3 lakh rupees for training them. That is known as assembled workforce valuation. That the number of employees which the company had hired until now and how much time they've spent in actually training them, even if they left after 4 months. They actually spent 3 months in training them and the person left in 4 months. It means that the company had actually invested into assembled workforce for a lot of time. That is one kind of an intangible asset. Come the second is, for example, if you acquired a company and it had a brand, so you need to do a brand valuation under relief from royalty method. If there is a customer relationship, that is the company has, let's say you're acquiring an edutech business, and edtech business is ideally having a lot of people who are paying them all through the year. And they know that the student who came into them at the time of second class will stay till the class 12th. Then in that case, there is customer relationship which has to be valued. Customer relationship is not just with, edutech startup, it's also with small factories. In small factories, there are a lot of customers which stay with them for a long period of time. So those are few things which we need to value. It's not just about, just goodwill. It's customer relationship, it's supplier relationship, it's brand, it's, the non-compete. If there is a non-compete which is signed by the owner, we do a valuation of with or without. So we do valuation when the non-compete is in place and when the non-compete is not in place. So we do these kind of valuations also. And then the difference between them is known as non-compete valuation. So that is also there in the purchase price allocation. And then what is left is actually valued all together. So now there is impairment analysis. One big thing, which actually Girish sir was also talking about, is the huge cost arbitrage which is there in India, which is known as 409A valuation. 409A valuation is ideally what it is that ESOP valuation which are done in other countries, in US and UAE and those areas. So this is a huge opportunity to work upon. Like for example, in case of Aranka, if you've heard of them, There are a few friends of mine who work in Aranka, a few friends of mine who work in Kroll. They told me there is approximately $1 million of business, which these companies are ideally doing, just doing valuation for 409A purpose. 409A is the ESOP valuation done in US. There are similar valuations which are happening in Middle East and other areas. Also, these valuations are being done by a lot of Indian players as of now. So there is company law, court order, mediation, arbitration. Valuations are needed for all of them. Now, coming next is in detail, I'll talk about, when you do fundraise, the issue of share, transfer of share, valuation for company act by registered valuer, valuation for income tax act by merchant banker, internal management analysis, for issue of shares, again for FEMA, for overseas divestment, deduction, indirect transfer, valuation by merchant banker or chartered accountant, income tax, there are capital gains, overseas transfer of involving Indian asset, buyback, issuance of shares, transfer of shares, transfer of acquisition of intellectual property, for IGAP, for pre-deal PPA, post-deal PPA, impairment, valuation of options, buyback, a lot of things are there. Do you know? For one, I'll need answers from you. For one issuance, I'll answer you why it is difficult to enter. For one issuance, preferential issuance of shares, valuation is needed under how many statutes? Let's say the money is coming from Singapore. Then can anyone tell me the money is coming from Singapore, the Indian company is issuing the shares. Can you tell me 3 statutes under which the valuation is needed? FEMA, Anu is saying FEMA, great. RBI and FEMA are same. So no different statute. Wonderful. Rahul said Income Tax, Companies Act and FEMA. India's will be needed in a later stage. So Income Tax, Companies Act and FEMA. And all 3 have different requirements. Income Tax Act, on one side, when the money is coming from abroad or from anywhere, it says that the valuation should be point valuation. It can only have 10% difference. So let's say you are raising funds at 100 rupees. Income Tax Act, section 5627D of the Income Tax Act, read along with Rule 11, US says the valuation can maximum be rupees 100 or 95 or 96, 10% difference altogether. So it says 100 rupees. FEMA, on the other side, says a floor valuation. That is, if your company is valued at 100 and someone is investing, they may invest at 300. I am not bothered about it. Yeah. So there was time when non-residents were not covered under Income Tax Act. Now they are covered. So the scope of the valuation has increased over a period of time. Then come Companies Act. Companies Act says valuation is needed by registered valuer, which is Insolvency Bankruptcy Board of India registered valuer. Income Tax Act says the valuation is needed by a merchant banker. FEMA says you can take it from a chartered accountant or a cost accountant or a merchant banker. So for one transaction, there are 3 different valuations which are needed in the FEMA, under Income Tax, under Companies Act. 3 different transactions for 3 different work. Now, in case, let's say, in the same transaction, there is some secondary transfer also. The primary transfer is known as primary issuance, that is preferential allotment. Secondary transfer is ideally the transfer of shares. If that is happening, then Income Tax Act also sits on one side and says, I am giving you a floor valuation. In that case, I'm not giving you a ceiling valuation. So in a single transaction, wherein a transfer of share and issuance of share, both are happening, in those cases, people will ideally have different ways of doing the valuation via different authorities for different statutes altogether. So my question to Girish sir was also like that when do you think this will converge into one, which according to his opinion is they will always be divergent and the regulators will always work in silos over a period of time. And yes, it creates a lot of opportunity for us because till the time they work in silos, till that time we will have a lot of work to do. So it's okay if it is being done in silos and it remains like that. According to me, within 5 years or 6 years down the line, all valuations should ideally come to registered valuer instead of going to a merchant banker. The option should always be there of getting a valuation done by a registered valuer or a merchant banker, and one valuation report should ideally work at all the places, which should be the case. But that will take time because regulators should sit together, will take some time, and there should be a need of sitting together. Now there is a lot of requirements at various places. Next comes is the very important rule under Income Tax Act, Rule 11 UA. Can someone tell me what was the date of this amendment? There was an amendment which came under Rule 11 UA. Can anyone tell me what was the date of this? Anyone can tell me a month of this, maybe month and year, when this Rule 11 UA was amended? Does anyone have any answer? No? So this actually happened on 25th September 2023, that 11 UA was amended. So what was there in 11 UA is 56 to 7B of the Income Tax Act said that in case the money is coming from a resident, then you need a valuation report. If the money is coming from a non-resident, you don't need a valuation report. That was said under the Income Tax Act. But the Income Tax Act got amended and they brought in non-residents also in it. They did exempt the whole of European Union, US, UK and few of the areas, but the most of the money, 70% of the money was coming from Mauritius and Singapore, which is not exempted. So you need to do valuation under non-resident for that also, but there came few things which actually allowed for BC, for AIFs and all of those to have no valuation report as such. But the problem here is in one transaction wherein there are residents as well as non-residents, you need valuation. They have given two different methods of doing a valuation. Now, I'm asking a question to the participants here. Can two methods of valuation converge at one valuation, or will they always have different valuation numbers? If I'm doing valuation via comparable company multiple, which is multiple, and I'm doing valuation on DCF, can they both give me exact valuation in a good environment, in the best setting environment? Do you think can they give same valuation? No. Sumit Gupta says no. Wonderful, Sumit. So now the problem is, let's say there is one transaction wherein I'm taking money from residents and I'm taking money from non-residents also. Can I do one transaction at two different valuations? No, that's also not allowed. So how can there be two different rules for single transaction having same valuation? Now, what does it say is for a non-resident, for a resident, the valuation has to be done by a merchant banker under discounted cash flow method. For non-resident, there are few methods which are comparable company multiple method, probability weighted expected return method, option pricing method, milestone analysis method, replacement cost method. They came with names which they also don't know meaning for. Option pricing method, milestone analysis method, replacement cost method. I was sitting at one of a board meeting by DPIIT wherein few representatives came from the direct tax division as well, who were actually working on Rule 11 UA. I asked them the questions, can you give a guideline over how do we do valuation under these methods? And they didn't even know 5 methods were there, and they didn't even know the name of those methods. They didn't even know the meaning of these methods at all. But the point here is not that valuation is being done at different methods, whether this is okay or this is not okay. The problem is that if the funding is by both resident and non-resident, can valuation be done by two different methods in the same report? Can there be two different valuation in the same report? Can I do non-residents via comparable company multiple? They'll come at 120 rupees and a resident will come at 100 because discounted cash flow is not giving me this valuation. I cannot do that. I have to converge at one valuation. I have to do valuation via one method ultimately. Now, let's say there's another wonderful thing which came in and which is an acceptable, a welcome step by the government, is valuation is valid only for 90 days from the date of valuation report. Now, this happens a lot of problem. This is a main problem. Do you know under Companies Act, there is a very, conventional thought process, which it says that, not conventional, it is because of the procedural issues. It says that the valuation report should be at least 1 month old. And I'll tell you why. Valuation report will first go to board. Board will have 7 days of notice period. Then board will give a 21-day notice period and EGM will come. So it says that approximately 30 days will be required for conducting the EGM. So it says the valuation report should be at least 1 month old. Now, Income Tax Act says that the valuation can maximum be 90 days old. Can maximum be 90 days old. Can be 1 day old also. But in Companies Act says the valuation should be at least 30 days old. So now it is just 60 days which are left to consummate a transaction. Now what happens a lot of time is, I'm doing a valuation as of now, wherein the transaction actually happened in 25th October. The first transaction happened on 25th October. And till now, the round is open. And the round will ideally get over by 17th of February. So which means that the whole round went for more than 5 months. Now, because it went for more than 5 months, there are two valuation reports needed by a merchant banker. One valuation report, because the valuation, the first transaction was happening on 25th October. So we were supposed to get valuation report at least 1 month older to that date. So we were supposed to get a valuation done on 31 August so that we can get a valuation report date on the month of September. Now in the October, when the transaction happened, I'm sitting currently in the month of February where the transactions, overall transactions, there were 10 investors who were investing. 6 have already paid money, 4 have still to pay money. So I have to get another valuation done on 31 December. Now I do another valuation on 31 December that needs to come from a merchant banker separately. So now this is a problem for the company, but definitely opportunity for chartered accountants. Now you say, how does it is an opportunity for a chartered accountant when a merchant banker has to do the valuation? Is because you are the first point of contact of any client. They don't go to merchant banker. They come to you to ask you where the merchant banker is, and merchant banker will ideally help you to do the valuation. It says consideration can be max 10% exceeding the valuation. So if the valuation is 100, you can ideally have consideration of 110 or something like that. It cannot be more than that. It also says, now the problem is 90 days from the date of valuation report. Now, can anyone tell me in the chat box, when it says date of valuation report, is it the date of valuation or is it date of signing of the valuation report? What would you imagine? Is it 90 days from the date of signing? Anu says signing. Or is it the date of the valuation report? So I did valuation on 31 August, but the report came on 7th of September. Will it be 31 August or 7th of September? Date of valuation report. This is 7th of September. Rahul says 31st August. Date of valuation तो मेरा question ही है तिलक राज जी. I'm asking what is date of valuation? Valuation report. I'm asking 31st August or 7th September. Report. No. So the law is silent on this. I really don't know whether it should be the valuation report date or it should be that. But what are we taught in the taxes? What is more complex? Consider that. What is more complex is ideally the 31 August, which is the valuation date, and not the report date. So I am considering that 90 days should be from the date of valuation report, not from the valuation. It should be the valuation date, that is 31 August, and not 7 September. So in that case, you should also consider it like that. And going forward, for one transaction, you may need two valuations. One will be done on DCF, the second again on DCF. But how do you do that? So that is a problem which happens. We'll be talking about that in detail going forward. Now, going to the next slide, there is one myth in the industry which says that a startup does not need valuation. They are exempt from angel tax. Is it true or is it false? Can someone tell me in the chat box? Are startups exempt from angel taxation? Anu is saying false. Anyone else? False. So I'll tell you, it is actually true, but it comes with a rider. What rider does it come with is, if you get the money without a valuation report, you need to file form. There is one form which needs to be filed on the DPIIT platform, which you can do it. But the question is that if you do a valuation, if you do a funding, you get a funding without a valuation report by a merchant banker, you are restricted to open any subsidiary for next 7 years. You cannot invest into any shares and security. You cannot do capital contribution to any other entity, which means that you can never open a subsidiary once you have actually taken money and without a valuation. All other are still manageable because it says loans and advances, land and building, building on land, motor vehicle, jewelry, if it is other than business. So definitely I cannot buy a house for myself from the company's money. That's okay. Loans and advances I can't give without in ordinary extended manner, in ordinary course of business. I cannot give that. That's okay. But the main problem are the red one here, the capital contribution and shares and security. So you can't really do capital contribution. You can't really do shares and security. So if any startup comes to you and say, we have exemption under the DPIIT, just tell them that if you take the exemption under DPIIT and you don't take a valuation report, the problem with you will ideally be that you will never be able to open a subsidiary, or you will never be able to invest into any other company who is maybe in the similar line of yours for next 7 years, which is huge, and you never know what you're supposed to do in any amount of time over a period of 7 years. So hence you should inform your startups about it. Now people ask me, when you go to a CFO asks you that how do you do valuation? So you tell them that, but are the restrictions actually bothering startup? This is a problem actually. So Rahul is asking, are these restrictions actually bothering startups? These restrictions, startups want to save money at all moment of time, so they don't want to pay a merchant banker. It is you who is the the consultant to them, who need to tell them that no, brother or sister, if you call them, you should not be taking money without a merchant banker report. Otherwise, it restricts you a lot of places. Now, startups wouldn't understand this because most of the pre-seed and seed startups are coming from the students who are at 23, 24, 25, or in the starting 20s or end of 20s or early 30s, like that. They don't have the maturity to understand that they may have to invest into things later on, and this could be a problem for them. So we need to make them understand that you will have to invest into some startup going forward. You may have to invest into some company. You may have to acquire a company over a period of time. If you don't take valuation right now, you will be having problem in the later stage. I was just looking at question and answers. There is a big question which is there, which I will take at the end. Yeah. So now, when you go to a company and you tell to a CFO that how do you do valuation? So you tell them that I'll be analyzing your historical data first. Yeah. Then you will be analyzing the financial forecast. Then you will ideally be going for holding discussion with the management basis the financial forecast. Then you will do industry research. Then you will conduct valuation using appropriate approaches and prepare valuation report and discuss the results with the management. So that's the whole process which you need to follow. So that's the whole process which you need to follow. That is, first you analyze the historical data, then you broadly analyze the financial forecast, hold discussion with management, conduct industry research, conduct valuation using appropriate approaches, and prepare valuation report and discuss the results with management. Now, the second question which the CFO will ask is, मुझे समझ आ गया that you know how to do valuation, but can you tell me what all information is needed to do the valuation? Can someone in the chat box just list down 3 things which are initial to do valuation? Basis this, I'm saying we'll analyze historical data. So we'll need historical data. I'm saying we'll broadly analyze financial forecast. So we'll need projections. I'm saying we'll hold discussion with the management. We need to know who the management is. So we need to have shareholding pattern. Then we are doing industry research. So we may ask them if you have any industry reports per se in the market. If they don't have it, that's okay. If they have it, please give it to us. So these are the information which are needed. Provisional financial as on the valuation date, projected profit and loss account for a period of 5 years, anticipated working capital requirement or capital expenditure over the forecast period, fully diluted shareholding pattern. This is very interesting. We'll discuss at the end. Fully diluted shareholding pattern. Other relevant details such as history, shareholding pattern, past and present activities, future plan and prospect, other relevant information and data. These kind of things are very much needed. Now, there are 3 approaches of doing valuation. One is the cost approach. The second is the market approach, and the third is the income approach. There is a research by PwC, basis the valuations which are done worldwide by PwC. This says approximately 58% of the valuation is being done by discounted. So they say 58% of the valuations are done by discounted cash flow method. And then comes the NAV method, because there is a lot of regulatory requirement which talks about getting valuation done by NAV method. So approximately 58% are done here. 20% is done by NAV method, which takes around 78% of the total valuations. There is just 22% of valuations which are needed under market approach. Amongst that, 10% goes by market price method, because again, regulatory requirement that the valuation under SEBI takeover code needs to be done on the basis of 60 days moving average of the share price. So hence the market price method. Rest is left here, which is the 12% valuation, which is happening under comparable company multiple method, comparable transaction multiple method. What we are discussing today is the most important method of valuation, which is discounted cash flow method. So now, just to revise back before we start with the discounted cash flow method, what we have discussed until now is where all the valuation is needed. These are few of the areas where it is needed. Anyone wants to take a screenshot of this, they can ideally take it, can go back, read all these sections and take benefit of the same. The second is the purpose, regulatory, accounting, and dispute resolution. The third are these areas specifically talking about in detail what all valuations are needed. Then we talked about a little about 11 UA, wherein a new method has come up under the NR route. So we talked about this for a while. Then we talked about the issues which are ideally there in the valuation report in the Rule 11 UA. That is, there are two different methods for resident and non-resident. 90 days consideration can be max 10%. What is the date of valuation report actually? So we discussed that. Then we talked about why startups need valuation. We talked about what is the process of doing it. We talked about valuation methodologies. We talked about sources of information. Now comes the main topic. So, which is what is discounted cash flow? What are these? So, Nishan will definitely share. I'll share it with Voice of CA, so they'll share it further with you. In case of Gen 1 HVT under 56 to 10, can the valuation report help to deal with higher SDV? What is right approach to deal with this? In case of Gen 1 HVT, what is HVT, Vishu? I'm sorry. Under 56 to 10, can the valuation report help to deal with higher SDV? I'm sorry. Just give me the full forms of these as well, because I may understand it in a different way. You may understand it in a different way. If our firm raises funds through issue of optionally convertible cumulative preference share by 350 crore and issuing company share capital and other equity is 650 crore, then will the issuing company become subsidiary as per Ind AS? That Karthik will answer you actually. So Karthik will tell you whether it will come under Ind AS, what will happen under Ind AS. When we have bigger person to talk about Ind AS, I'll not bother doing that. Now, coming to DCF method, how do we do DCF? There are 4 pillars of DCF. The first is the projection. The second is the discount rate. The third is the terminal value, and fourth is the after adjustment. So, high value transaction, stamp duty value. So you can ideally, yes. So Vishu, now coming to your question, which says that if there is a Gen 1 valuation under 56 to 10, can the valuation report help to deal with higher SDV? What is the approach to deal with this? Yes. In case you are having, so what I do in case of 56 to 10 is wherein the valuation report is needed, I do not certify even the stamp duty. I take a valuation report of the land and building from a IBBI registered or a wealth tax registered land and building valuer, and I rely on his valuation. I don't do valuations on my own in case a land and building is involved in a valuation. So what you should ideally do is to approach to deal with this is a chartered accountant is not supposed to do valuation of land and building. We're not allowed to do that. Even under Insolvency Bankruptcy Board of India, we can't get registration under land and building. So you should always use a land and building valuer while doing the valuation under even 11 UA. So this solves your problem over a period of time. Yeah. So coming next, the first and foremost is projection. You'll say, Gaurav, you told that projection is the responsibility of the management. Then why are we talking about it? Is that because all the statutes in any act where it talks about a valuation and all the regulations and all the standards actually say that the valuer needs to have certain or sufficient understanding of the projection. That is, the valuer should have the understanding of the projections from the perspective that they are logically correct and should have basis of the same. The valuer cannot do valuation on the basis of projections, which has no basis at all. So if a company sends you a number that we are currently at 100 crore and we're going to go 150 next year, 220 next year, 370 next year, and 450 next year, you got to ask them question, how are you going to do that? Yeah, I'll be giving you a few examples on this. But so I'll start with an example ideally. There was one valuation which I was doing for an aeroplane company. So they were jet manufacturers. Yeah. Very interestingly, the company told me that we are currently doing a transaction, we are doing 100 crore as revenue. They were doing approximately 1,000 crore of revenue. Next year, we are going to do 2.5k crore to 2,500 crore. Next year, we're going to do 5,000. Next year, we're going to do 10,000 crore. So I was okay. I had no problem. Okay. Whatever you're saying is okay accordingly. I asked them, how many jets do you sell right now? So they said, last year we sold 11 jets. I said, okay, that's okay. Second, I asked them, how much are you expecting to sell next year? So they said, we're expecting to do 25 next year, then we're expecting to do 75, then we're expecting to do 100, then we're expecting to do 250. So I was okay with it. I said, okay, you're gonna go from 11 to 25 to 75 to 100 to 200, that's okay. How many seater jets do you generally manufacture? So they said, we are a very niche company. We do an 8-seater or a 10-seater jet, that's max. And we don't manufacture anything other than that. So I was okay with that. So what I did was I took the projections for them and I went online and various reports and everything, and I looked at what is the current market of 8 to 10-seater jets altogether. In a year, do you know, only 75 people buy these jets. Only 8 to 10-seater jets are sold, 75 in number. Every year, this number is increasing by 20%. So that goes to 100 or maybe 120. So in the first year, I was okay with they selling 11 out of the 75 jets. That was okay. Second year, they were selling 25 out of maybe 80, which is the total market. That's also okay. Next year, they were selling 75 of the total 90 jets being sold. That's what they were projecting about. It's still okay that they're going to acquire the whole market. There is no other seller who's going to do. The next year, they were saying, the last year, they were saying 200, when the requirement will be 150. Then I went back to them and I told them, sir, you have a problem with the projections. You are talking about that you are going to sell, let's say 100% of the market share, but you can't sell more than what is required in the market. Where will you get the buyers from? And they were amazed by the thought process that, yes, Gaurav, we didn't think about it. While we were doing the projections, we just wanted a valuation number and we did the projections like that. We didn't create the projection scientifically. I'm really sorry about it. Can we sit down and do that? Then when we sat down, we actually talked about in detail that, the number of the jets, you should actually include various jets of 12-seater, 20-seater, 25-seater, 30-seater jets, so that your revenue increases even when the number of jets are going down. So that was one example which I did. And this is how I did was I did common sizing of their EBITDA numbers. I did common sizing of their revenue numbers. I did common sizing of other areas and I got to know about this. Then comes year-on-year growth patterns, which I told you 11, 25, 75, 100, 250, which was not looking nice to me. Then industry trends. I told you aeroplane industry that was doing only 75. So that was not possible at all. There was another conventional business owner, yeah, which was doing steel pipe manufacturing in Manesar. He came to me and he said, Gaurav, at 2,000 crore valuation, I am raising 200 crores. So I was okay. Yeah, great. You're doing 200 crore fundraise at 2,000 crore valuation. That's wonderful. And he told me, Gaurav, I'm sending a projection. So he sent me projections. I was happy about it. When he sent me the projections, the problem with that was they were currently doing 100 CR of revenue. Next year, they were planning to do 120 CR, then 150 CR, then 200 CR, and then 250 CR. I was good. I was happy about it that my client is growing. Only chartered accountant is one profession which is happy with its client growing. When a doctor or a lawyer goes, you know about it, the problems. So 100, 120, 150, 200, 250, I was happy about it. So I told them, sir, can you tell me what is the current capacity utilization you have? He was very amazed about it. So he said, Gaurav, my capacity utilization is ideally 85%. I was like, wow, it is 85%. And you are actually talking about going from 100 to 120. Maybe inflationary trend or something, you may go to 120. But how are you going to achieve 150 CR over a period of time? So Mr. CFO told me, I don't have that answer. So we went to the production head in that case. and I asked them about it, that if you are increasing the number of the revenue, which is more than your capacity, you must be getting job work done. So he said, no. I cannot get job work done. It's because my management has already told me that the quality of the steel pipe should be consistent and that will not come in job work. So I said, okay, no problem. You must be doing trading in that case. That is, you're acquiring from a captive industry altogether. He said, no, that's also not possible because in trading, the prices fluctuate a lot. So my management has told I can't do trading. So, okay. Then I went to the capex. I thought they must have done capital expenditure to actually get this number. And when I went to capital expenditure, there was no capital expenditure. There is no expansion which they're doing of the industry. I asked them, how are you going to do that? And they were perplexed by it altogether. They said, Gaurav, I really don't have this number. Can you help me to actually create the projections of my company? And you know, there you add the value to the company. Now, a lot of time people say, number भी उसने बताया valuation का, funding भी वो लेकर आया, तुमने valuation वो दी जो उसने बताई, तो किस बात की fees? The fees is all about the story you create around it, the right story you create about it, the right valuation you give. So we need to understand the total addressable market of a industry. So I was doing valuation of a garage owner, like Go Mechanic is there. So I talked about that in the whole of the country, there are approximately 1 lakh garages. Yeah. Out of that 1 lakh garages, that is the total addressable market of the country. Serviceable addressable market is that if there are 10 garage shops, only 3 will actually take a brand on their own. 7 will work on their own. So that means 30% is only the serviceable addressable market, which is talks about 30,000 garages altogether. The third thing was ideally serviceable obtainable market. That is, let's say 1 lakh garages, 30,000 narrowed down to only will take services like Go Mechanic. There are several players who are doing business like you, which means that you will get maximum 25% of the total chunk of the serviceable addressable market, which talks about if you are at 30,000 number, you will ideally be talking to 1/4 of that. You know, so that came all together with the thing that is we talked about the SAM serviceable addressable market. Then I looked at the customer acquisition cost. You know, there is a lifetime value of a customer. Lifetime value of a customer is that if a customer comes to you, how many times will he buy from you again and again? So I saw that a lifetime value of at least 5 years of a garage who's coming to me is approximately 5 lakh rupees. So the customer acquisition cost per garage can ideally be 20,000 rupees. They're spending 20,000 rupees to acquire one garage, which means when they have to go and talk to total addressable market, then they will know who is the serviceable addressable market, and then they'll obtain the serviceable obtainable market. And the CAC is ideally for all of these three. So the problem is the CAC, the customer acquisition cost, will only go to one. So I see a few hand raisers. Yeah. Vishnu, you wanted to ask something? I've Vishu Buddhiraja, you wanted to ask something?
Gaurav sir, continue
Yes.
please. Continue please, continue.
Okay.
Yeah.
So that is their common sizing. Now, I would like to know how many of you are currently investing on shares? Yes or no? How many of you are investing through shares? Yes. Yes. I see most of the people will be doing, will be investing through shares. Now, we invest in a way that my friend Ramesh had actually invested into one share that went 40% up. So I'm going to invest in that share. That is the way we generally invest into shares. Now, that is not the way we should invest. There is a specific initiating coverage report and analyst report, which comes for various transactions. Now, if a mutual fund investor is actually investing into Reliance Industries and is increasing their stake, they will take out an initiating coverage report of that company and they will tell us that what do they expect from that company in next 4 years or 5 years altogether. So they will tell you that they are expecting that the company will grow by 20%, 30%. The margins will grow by that. The number of people will grow by that. The new businesses will grow by that. That's how initiating coverage report is there. Then budget or target, but not aspirational. That should ideally be budget or target. It should not be aspirational. Then comes whether, there is one more thing that a lot of time people have given projections to the investors also. And the problem is that the valuation, the projections which are given to the investor and the projections which are given to us are not the same. So we need to talk to them and ask them that if you're giving a projection, the projection which are given to us and you're giving to the investor should be same. So while you are talking about the projection as such, you need to see that you do common sizing, you do year-on-year growth pattern, you look at the industry, you look at initiating coverage reports, you look at budget or target. It should not be aspirational. It should be, you should check whether same projections are given to investors or not. Sometime when you are doing a valuation, the projections which are given to you and the projections which are given to investors are very different. Yeah. So we need to take care of that as such. Next, most important pillar. Actually, the valuer gives his consent over the discount rate. So for the discount rate, I will ideally take you. So I was bringing the laptop in near to me. I will ideally take you to one of my work which I have recently done. It's not the recent one, to be honest. I did it for 31st March 2023. And I'm just talking about that is because it's very interesting. So now the point is there are a lot of fantasy game companies. Can someone tell me a few names of the fantasy game companies? Dream 11, wonderful. Dream 11. Yeah. So there was one of the fantasy game company which came to me for getting the valuation done. Now, as you know, there are a lot of regulatory issues and all of those which are there. I looked at few of the comparable companies which were there in the industry. So when I looked at comparable companies, there were very few in India. Can someone tell me, if you go to Goa, there is a company which runs a cruise there, which is the listed entity. Can someone tell me what's the name of that company? Name of the company which runs a cruise, which is a listed entity. Can someone tell me in the chat box? Name of the company which is running cruise in Goa and is a listed entity. Delta. Yeah. So Delta Corp is the name of the company and Delta Royale is the name of the cruise which is running in so that is the only Indian company ideally. So I'll tell you, when I looked at the countries as such, headquarter country, I looked at India as such and I got only these companies, which was Nazara Technologies, Delta Corp, Nazara, and these. Birla Shloka was actually not listed, and Seven Seas Entertainment was actually not doing this work, and they had very bad revenues as such. I had only these two, and I couldn't consider them because their net income was less than zero. They were actually doing losses over a period of time. So what I had to do is I had to look at worldwide comparables, which is 1,000 and whopping 1,084 companies who are into this number, who are there in the fantasy gaming or the gaming side. So I had to actually do the filtering out of all these companies, whether it is not listed, the MCAP is zero, the zero beta, the revenue is low, not similar business, not in range, no revenue, net income is less than zero. All of those things I had to do and get to a number. So I got down to a buy of approximately 7 companies altogether. That is, only 7 companies were there who were comparable companies to me. Can anyone tell me what is CAPM? What is the full form of CAPM? Capital Asset Pricing Model. Yes, Rahul. So yes, Rahul, this data was taken out by Capital IQ. And Capital Asset Pricing Model. What is Capital Asset Pricing Model used for? For valuing or for taking out a discount rate? Which discount rate? Equity. Prachi says equity. That's wonderful, Prachi. So it's actually to take out both. So now the purpose, the point here is that while we do capital asset pricing model, the formula is RF plus RM minus RF. That is risk-free rate plus RM minus RF. That is the formula is. So now, what is the risk-free rate of our country? Can anyone tell me? What is the risk-free rate of our country? Is it what we invest in HDFC at 4.5% FD, or is it something else? T-bill, Anu is saying T-bill, repo rate. Okay, Prachi is saying repo rate. Government bonds, Rahul, yes. So it's actually 10-year government bonds, which are the percentage. So we look at these, I looked at few of the dates which were there, 31st March, 30, 30, 30, 7.53%. Then I looked at, that was RF, which I got. Second is the RM, risk premium. So I'll give you a very, very simple example for this, that what should be ideally be used. But first we'll talk about beta. Is beta. Yeah. Beta is the sensitivity of a stock to the index it works with. So for example, if Reliance decreases by 1%, Sensex goes down by 1%, Reliance also goes down by 1%. What is the beta of Reliance then? Can someone please tell me? 1, yes. So there are companies who have negative beta. Can someone tell me which industry actually goes down when the Sensex goes up? Or if the Sensex goes down, that industry goes up? Can anyone tell me that? Gold. Wonderful, Prachi. Anu is saying medicine. No, it's not always medicine. That was COVID that happened, but that's not always medicine. So, these companies used to have negative beta, but now because of Zerodha and people saying that please invest into gold, please take that. The beta of gold has also gone down, has come up to 0.6 approximately. Now, when I was looking at this company, these companies had a beta of 1 as comparable. And, I will read it. Just give me. Yeah. So beta of 1 was there when we were talking about these companies approximately, because they were abroad. There is more mature, there is more known market in those countries. So hence they were at a beta of 1. But in our country, it should be different. Now I tell you why it should be different. Okay. Can someone tell me what do you generally earn? I'll take back to the presentation. What do you generally earn from a blue chip mutual fund over 5 years on an average? Can someone tell me? 12 to 15%. Okay. From a small cap mutual fund, how much do you earn? Small cap mutual fund. Approximately a range 20 to 25%, Prachi says. So let's say for a safer side, blue chip mutual fund will ideally give me a 12% return, which is reasonable and acceptable for sure. And a small cap mutual fund will ideally give me an 18% return, which is also acceptable over a period of time of 5 years. Yeah. Now a startup came to me and startup told me, Gaurav, would you be investing into my startup? I said, okay, but my return would ideally be higher. He said, what return, Gaurav, do you expect out of my startup? So I told them, if I invest into a small cap mutual fund, I get approximately 17 to 18% as return. Now, if I invest into a startup like you, your startup is much more riskier than a small cap mutual fund also. So because of the risk, that is discount for size, margin, and business dynamics, I am expecting that your startup will ideally be at least 25 to 50% more riskier than what would be a small cap mutual fund be. So he was like, okay. So I told him that to invest into your startup, let's say a small cap mutual fund was at 18, I will expect at least 2% more from you. He said, okay, no problem in that case. Then I told him, your startup is currently valued at 100 CR. I will be investing 1 CR. He said, okay. And I said, when I'll be investing 1 CR, I will come to you every week to ask you the question. He said, Gaurav, just wait. You are getting just 1% of my company by investing 1 crore into my company. I'm not going to allow you to come and sit with me even for a day? I go, okay, give me quarterly financials. He said, no, I'm not going to give you quarterly financials. You download, pay 50 rupees, tell your chartered accountant to give you the projections and even my financials. I was like, in that case, I need to have a minority discount. That is, I don't have any say in your company. Then I need at least 1% more return from your company. He said, okay, no problem. You were expecting 18% from small cap. You're expecting 2% extra from discount for size, margin, and business dynamics. You are expecting 1% more from minority discount. That's okay. But I told him, bro, I can sell small cap mutual fund any mode of time. I have it right now. I want to sell it tomorrow. I want some liquidity. There may be tax implication, but I can at least sell it. There is market for it. Where will I sell your stock? He said, Gaurav, I am currently at 1 crore revenue and I'm going to go for an IPO within 5 years. And I believed in him. And I told him, yes, you're going to go in the IPO in next 5 years for sure. You are currently at a revenue of 1 crore and you're making losses of 7 crores as of now. And you're saying that you're going to go in the IPO very soon. So I'm happy to listen to your positive things. But there is no one who's going to buy my shares as of now. So there is discount for lack of marketability clearly for your shares, which I own. And there needs to be a range of 20 to 60% for discount for lack of marketability in that case. And he agreed to it as well. He said, okay, you add 2% more for discount for lack of marketability. Gaurav, what else do you need? I was like, that's wonderful. He's ready to give me a return of 23% approximately, which 18% above 2% for discount size and margin, 1% more for minority discount, 2% more for discount for lack of marketability. Now, I have seen valuation reports coming from a lot of valuers wherein the discount rate for a startup has been kept at 13%. How can a startup be valued at 13%? You tell me that. A startup which has nothing in the line as of now, it's at a beta stage, it's doing a pre-seed. How can that be valued at 13% cost of equity? So that was the problem which is there in the industry altogether. Now came another thing. I was very happy with this guy who was ready to give me 23%. I told him, bro, I'm a big man. I never told you about it. I have a lot of money in my pocket. I'm not going to invest 1 crore in your company now because you're a good guy. I'm going to invest 20 crore in your company. Someone is agreeing to give me 25% approximately. I'm ready to give him 2 crore rupees. So I told him that I'm going to invest 20 crore in your company. He said, now, Gaurav, you come every week to me. I will give you information. I'll give you quarterly information. I'll give you half-yearly information. I'll give you monthly information. You're investing 20 crore. You're getting 20% of my company. I will give you one board seat in my company. But wait. I said, what? He said, now you don't have minority discount, but you have a control premium, which means that because you have now control over my company, so your shares should command less percentage of return when it is compared to a minority person. So leave behind that 1% which you were talking about for minority discount. Now I will give you 1% less for having a control premium. So you were 23% there, 1% gone for minority and 1% gone for control premium. You are going to sit at 21% for this company altogether, and that's how the discount rate will be for my company. So I was happy about doing that also because he talked about me in the valuation terms, and because someone talks to me in a valuation term, I invest better, but I don't invest, so I'm really sorry. So that's how the overall thing was. People are saying kindly provide your contact number also. My contact number will be available at the end of the session. You can also go to Karthik and ask for my mobile number, even voice of CA for that. So that's how the 4 things are there: minority, control premium, discount for size and margin, discount for lack of marketability. There is one more important aspect. A lot of people says that there is no comparable of my company, and hence there is no beta. I consider beta of 1. That's written in a lot of valuation reports. You will see a lot of valuation reports saying there is no comparable company in the industry which is comparable to me because they are not at exact revenue to which I am sitting at. They are not in the same industry where I'm sitting at. There is no company which has no comparable. Recently, Ola came with their IPO. Yeah, I was part of doing the valuation in few rounds, and they also said there is no comparable company to us. So I went to them and I told them, bro, you belong to two-wheeler industry. Now, if people want to buy two-wheeler, then they will have an option to buy a gas or an electric vehicle. If they're not buying two-wheeler, you are not going to sell anything to anyone. So if there are 1 lakh two-wheelers being sold in the market and you are targeting approximately 15% will be sold electric vehicle, which is currently 23%, then it means that you are catering to the two-wheeler market as such. So the first and foremost thing is that is the two-wheeler market is your industry. So the whole industry of two-wheeler is actually your industry. If the two-wheeler industry is growing, then only people will come and buy your product. Otherwise, people will not come and buy your product. So there is no company which has no comparable company. But a customer came to me and a customer told me, Gaurav, can you do my valuation? I said, okay. He said, I'm working in blockchain technology. I go, oh, wow. So he told me that what do I do is I get a lot of paintings which I need to sell via auction. So I said, okay. So he said, I go on Metaverse. Please listen it very carefully. I go on Metaverse. I do an exhibition there, wherein people come in the avatars, buy the painting in the NFT form, pay me in USDTs, and I get an INR. That's how my business is. I was convinced there is one company where there is no comparable. And I said, you are that company. I finally got a company who has no comparable. But because I say in all the seminars that there is no company which has no comparable, so I had to prove him that you are no company which has, you are also a company which has comparables. So he said, how do you find my comparables? So I looked at a lot of companies who are there in US who are actually doing auctions. That was one comparable company to them. That is those companies which are getting auctions done. Similarly, he's getting the auction done. Number second is that the exhibition, the art exhibition companies were the comparable company to them. There are a lot of listed art exhibition companies who have a lot of galleries all across, and those are the comparable company to him because that's the same industry, that's the same customer that he's catering to. Number third was ideally the SaaS platform which he has created. So he's created a SaaS platform which actually helps to do an exhibition today, can also help to do a conference tomorrow. So that was where I told them that you have comparable companies and you're going to do, we are going to do valuation considering all three of them. So there is no company which has no comparable. The second thing is people. So can someone tell me a living god of valuation? Who is considered a living god of valuation, living teacher, living god of valuation internationally? Can anyone tell me the name? दामोदरन जी, राहुल श्रीवास्तव is saying दामोदरन जी. अस्वत खुद को भी दामोदरन जी नहीं कहते होंगे मतलब ऐसे कोई भी नहीं कहता, but दामोदरन जी, it's wonderful you're giving respect to him. Aswath Damodaran, yes. So Aswath Damodaran is considered god of valuation. I'll tell you why Aswath Damodaran is called god of valuation. Aswath Damodaran is told god of valuation is because whatever session he teaches at New York University, he puts that on YouTube and it is available for everyone. Every winter session, every summer session is available for everyone to learn on the YouTube. Hence, he is called the god of valuation. The second good thing which he does is every year he takes down a data which talks about beta of the industry as such and the countries as such, and people follow that beta and industry to benchmark the valuation. Now, I have seen a lot of valuation reports wherein people say that beta as per Damodaran. Now, Damodaran is not your partner, okay? He's not really your partner. So Damodaran himself, after taking out information, says that my number should not be considered for the purpose of doing any regulatory or general analysis of valuation. My numbers can only be used for benchmarking your numbers. So you just can't say that the beta is taken as per Damodaran. You can't really say that. That's not allowed. So I've seen a lot of valuation reports coming to me saying that the valuation is done basis the beta as per Damodaran, which is wrong till the time Damodaran is not your partner. It's wrong. So you can't really do that. I don't have Damodaran as partner, so I don't write that. And you're also not allowed to do that. So discount rate is wonderful thing to do. Capital asset pricing model. What do I do for calculating the RM, which is risk-free return, the risk premium? What I do is I take down S&P BSE 500, which is one of the biggest index as such, which was listed on 1st February 1999 at 1,000. In 31st March 2023, it is at 21,325. It took 24 years at a CAGR of 13.5%, which says that my risk premium will be RM minus RF, which I say RM. RM is approximately 13.5%. My RF is 7.53% across Big Four people consider India's miss market risk premium at 7% also, which is also acceptable as such. There is a lot of research with all the big four have done. They consider it 7%. Few big four consider it 8%. Few big four consider it 6%. It is generally in the similar range, 6, 7, 8. It comes like that only. So there is no problem. Then I consider discount for size and margin for 25% for my company, because my company was much smaller than the comparable companies which are considered above. Discount for lack of marketability, definitely, because I was considering companies which were there above, then minority discount I did not consider, because my investor was actually taking a control over the company. So I did not give a control premium, because that's already included in the projections as such. The synergy benefits were already considered. Basis that I came down to a cost of equity of 21%. Indian cost of debt was, I considered that they'll not get it more than 14, less than 14%. There are bases which can help you down to calculate the cost of debt also. So then the tax rate comes, and then the back overall was considered to do the valuation. So that's where we sit at the discount rate. Now, coming next is ideally the terminal value. Generally, when you do valuation, you're given a projection, right? The projections are given for, let's say, 4 years or 5 years at max. The major valuation actually comes from the terminal year. It does not come from the explicit value. That is, explicit क्या होता है? Explicit होता है जो projection मुझे company ने दी. Or then comes a terminal year. Terminal year is basically the perpetuity में उसकी क्या वैल्यू होगी. That is, first 4 years में तो कुछ वैल्यू हो गई, 5 साल में वैल्यू हो गई. अब perpetuity में भी तो कुछ वैल्यू होगी, उसकी जिंदगी भर वो चलेगी कंपनी. Then there has to be some value to that perpetuity altogether. So what I did in that case is, we consider a terminal year growth rate. Terminal year growth rate, which is TVG, is ideally considered more than the inflation rate, but approximately near to the GDP growth rate of the country. The country's GDP growth rate is currently set at 7%, and the inflation, multidimensional inflation in the country, is considered at around 4.5%. So anywhere between 5% to 7% can be considered as TVG. So we considered terminal value growth rate of 6%. Now, to do terminal value growth rate calculation, we need to do 3 methods. There are 3 methods to do the valuation. The first method, because we are in lack of time, I'll not take much in detail of Gordon growth, H model, and exit multiple. There are 3 methods which are there. Gordon growth method. Gordon growth is the most simple method which is done for terminal year, and the most revered and the most used method to do the valuation. Now, this Gordon growth method is ideally capitalization of the last year terminal year cash flow. So what do we do in the Gordon growth method is, we do very simply, we look at the terminal year cash flows that is increasing by 5%. What we did was revenue increased by 6% approximately. So revenue increased by 6% in the terminal year. Going forward, 6% increase in the EBITDA. We considered the same depreciation which was there in the last year. We consider the taxes approximately. We consider the depreciation as the same. We consider that the fixed asset would ideally be the maintenance capex and not the growth capex, which means that whatever depreciation will be the fixed asset in the company. The current assets are ideally increased by a percentage of the revenue, which is ideally you can increase by 6%, which is the terminal value growth rate, whatever was the current asset movement in the last year. So that's how we do it. Then we come down to a terminal value method. Now, terminal value, how do we value is the last year free cash flow to firm divided by the WACC minus TVG. So divided by WACC minus TVG is the formula for Gordon growth method. It is capitalized by that. Now comes H model. H model is basically about that one, you are expecting that your company will grow at exponential in the last year also. So if it is growing at 30% in the last year, it cannot just jump down to 6% as return in the longer run. So you need to apply H model in that case, which says a very long method, which says that high growth period post explicit period will ideally be 6 years. There is a pure formula which is there for the H model available online. You can ideally go and check it, which says that, how do we gradually bring it down to 6% from 30%. So we bring it down from 30% to 6%, and that's how the H model is done. So, and then come the exit multiple method. If the company is not profitable at all, and the company's revenues have stabilized, but the EBITDA is not stabilized yet, then you put a exit multiple method at that moment of time on the revenue, and you don't do valuation by Gordon growth, H model, or exit multiple. Yeah. This is how the terminal year calculation is done. These are the most important two pillars. One is the discount rate, and the second is the terminal value, because this is the number which a valuer gives. If tomorrow a regulator calls you and asks you that you did a valuation, can you please give me a number? They'll be asking you these two questions for sure. These are your answers. So if you don't, you're not clear on these answers, leave about projections, they will trash the whole valuation report and will cancel your certificate altogether if you don't know about discount rate and terminal year. Coming next is the after adjustments. Now tell me something. A company has issued 100 ESOPs, not issued, has actually created an ESOP pool of 100 shares, has granted 10 out of them, and only one has vested until now. Giving you another example, another easy numbers. So note down 100, 10, and 1. 100 are the number of ESOP pool created. 10 is the granted number of ESOPs granted, and 1 is the number of ESOPs vested. What should be part of fully diluted shareholding pattern? 100, 10, or 1? 100 ESOP pool, 10 ESOP granted, and 1 ESOP vested. Tell me what should be? It should be 100, 10, or 1. I have written in the chat also. ESOP pool is of 100, ESOP granted is 10, ESOP vested is 1. What should be considered in fully diluted shareholding pattern? 100, 10, or 1? People are saying 1. So it should ideally be, which is 1, which should be 100. So it will be 100, that is, the whole of ESOP pool will be considered, not the granted, not the vested. Fully diluted shareholding pattern will have the whole of ESOP pool altogether, because आपने वो allocate कर दिए हैं for your employees. You've not given them as of now, but आपने allocate तो कर ही दिए. That's for sure. The second and the most important is the cash area. The cash is what? The idle cash. So what do people do is, जितना cash company के अंदर पड़ा होता है, they consider that the whole cash is actually the idle cash available. Now, generally to run a CA firm also, we need at least 3 months, 4 months, 5 months of cash available to us, of the salaries available to us in cash, so that we don't have to worry about paying the salaries. So we consider at least 3-4 months of money available to us. But what happens is that people consider the whole of cash as idle cash altogether, saying that the whole cash which is there in the company is the idle cash and they add it back to the company. So that's not possible. Then coming the valuation for the investments purpose. Now investment is, I was doing a valuation for one of the company which was in Singapore. It had its investment in Uganda, Tanzania, Africa, Dubai, UK, Canada, China, Russia, all of those places. And I had to do valuation of all the investments as such. I did valuation of all the subsidiaries. Then I added those numbers to the holding company and I did that as a valuation. So that is where the valuation, investment valuation is needed. Then comes land surplus assets. So tell me one thing. If a company is sitting on a land which is an office space and the company's valuation is 100 rupees, whereas the land value is 10 crore. So let's say 100 crore is the company valuation and the land valuation is 10 crore. Do I consider the valuation as 110 or 100? Nishant is saying 110. I'm repeating my question. Company's valuation is 100 crore. The land on which they are sitting is valued at 10 crore. Should the company valuation be 100 crore or 110 crore? Prachi, Rahul, Anu, Shriya, Vishu, Nishant has already answered. Can I have any of you answering back? Jackishan, 100 crore only. Yeah. So the point is, if while doing the projection, you had considered the land rental in the projections, then you can ideally consider land as surplus asset. But if you have not considered the rental of the land in your projections, then you cannot consider the land as surplus assets. You have to consider land as surplus asset when you have considered the rent. अगर rent consider नहीं हुआ, then you cannot consider land as valuation. Now, if you've considered rent, then you add land at the end. That's how. Then comes debt and debt-like items. So there are a lot of non-convertible debentures. There are a lot of compulsory convertible preference shares whose conversion is not known to us at this moment of time, which are ideally debt-like item but not debt. Those items we need to deduct at the end of the valuation. So when I talk about the four pillars of the discounted cash flow method, the four pillars are ideally projection, discount rate, terminal value after adjustment. Projection is required because you need to establish your value to the customer, the person who is giving you the business. The second is the discount rate. Discount rate is your number, so you need to be very sure about it. The third is the terminal value. It is again your number, and 50% of actual value comes from terminal value. So you need to be very cautious about it. And the last is the after adjustments. After adjustments are very important. You need to have the intricacy. You need to know what the after adjustment should be. What should be the fully diluted shareholding pattern? How much cash to be added? How much debt to be added? If you do these things, you are a pro of discounted cash flow method. So you determine the free cash flow, you determine explicit period, you determine the WACC, you determine the terminal value, your present value, all of that, and then you value using discounted cash flow method. So that's how the discounted cash flow method is. That's how the whole of the valuation overall industry is. So, and there are other methods also for doing the valuation under the startups, which are venture capital method, Berker's method, there is risk factor summation method for while we do. So these are not legal, these are not regulatory methods. Risk factor summation, scorecard valuation method, these are not there. This is something about my firm where I work as of now. I am partner there, National Leader Transaction Advisory. That's a bit about me, my contact details and all those. I am very, very thankful to all the participants who bared with me for approximately 2 hours. Listen to me. I believe I was able to add some value to the people who have joined in here. My special thanks to Karthik for being here, keep listening to me while leaving his whole professional work. To Neha, to Rajesh ji, to whole team of Voice of CA, to Girish ji for actually honoring this, and to all the participants who were here. I'm thankful to all of you. I'm signing off as CA Gaurav. Off to Karthik. Thank you, Karthik. Thank you very much.
Thank you, Gaurav sir, for this wonderful session. काफी टाइम के and it's my first session जो मैं moderate कर रहा हूँ sir, host कर रहा हूँ, and I listened properly to you sir. Complete 2 hour. मैं हिल नहीं पाया sir. Very honest with you, with your lots of experience and knowledge. Really thankful team Voice of CA on the behalf of Sanjay Kumar Agarwal sir, Neha Agarwal, Rajesh sir, and our whole team. We really felt grateful to you for your valuable time. And our member have totally enjoyed. Gaurav sir, एक आखिरी question है chat box के अंदर. The member is asking one question that, sorry to ask, basic question whether we need to generate UDIN for DCF valuation report.
So yes, actually, when you do 11U evaluation, it is a certificate, so you need to take out UDIN. I even take out UDIN for the purpose of Reserve Bank of India because the banks are also not accepting valuation report without UDIN, though it is not a certificate which was needed under FEMA, but the banks are not accepting valuation report without UDIN. So yes, for the purpose of DCF valuation report also you need to take out UDIN and you need to say that you are giving a certificate. I say you are giving a certificate, there is no report option available on UDIN. So while you were asking that do you give a certificate or a report, you always give a certificate under regulatory because there is no option to give under UDIN other than a certificate for a valuation report.
So thank you so much, sir. Thank you, sir. So Rajesh ji and team kindly sign off and we'll see you soon. Thank you so much.
Sure,
Thank
sir.
you.
Thank you, Gaurav ji. Thank you, Karthik ji.